What if I told you that the next big stock market crash might already be hidden somewhere in the digital depths of a machine? Imagine an algorithm that could, in theory, foresee the financial chaos we'd face tomorrow, next month, or even years from now. Would you believe it? And more importantly, would you trust it? In the fast-paced world of finance, timing is everything, and missing a single crucial signal could mean the difference between massive profit and catastrophic loss. As we edge closer to an age defined by artificial intelligence, a new question emerges. Could AI actually have the power to predict the next big financial meltdown? In this video, we're diving deep into the suspenseful possibilities of AI in the world of stock market predictions. We'll look at the advancements in technology, the successes, and the failures, all leading us to the burning question: will AI be our savior? Or just another false hope? Stay tuned as we break down how artificial intelligence could either revolutionize financial forecasting or leave us blindly facing another economic disaster. To understand whether AI could truly predict a market crash, we first need to look back at some of the biggest financial meltdowns in history and what caused them. Take the 2008 financial crisis, for example, a collapse so massive that it wiped out trillions of dollars in assets and left millions without jobs. Or consider the Dotcom Bubble, where the excitement around internet stocks led to a peak of irrational investments, only for the bubble to burst and wreak havoc. These crashes may seem worlds apart, yet they have one thing in common. Despite all the economic models, financial experts, and high-paid analysts, very few saw them coming. Predicting these catastrophic events has always been a guessing game, even for the most seasoned professionals. And the biggest reason? Human error, emotions, and the sheer complexity of market forces. Traditional forecasting models rely on historical data and set formulas that don't adapt well to sudden, chaotic shifts. This is where AI steps into the picture. Unlike traditional methods, AI can analyze massive amounts of data in seconds, learn from patterns, and adjust its forecasts in real time. But here's the catch. If stock markets are shaped by unpredictable human decisions and macroeconomic factors, can we really expect even the most advanced algorithms to predict when everything will collapse? In the past, experts have debated whether we could ever develop a crash-proof prediction model. But AI is different. It's a technology that learns, evolves, and may one day surpass human understanding. Yet this raises a whole new question. Is this technology capable of achieving what no human analyst has ever managed, or are we just setting ourselves up for disappointment? To grasp how AI might predict something as volatile as a stock market crash, let's take a look at how it works with data. AI thrives on one thing: information. Imagine feeding an algorithm with vast streams of financial data, stock prices, news headlines, social media sentiment, even global economic indicators, all in real time. What happens next? The AI starts to recognize patterns, behaviors, and correlations that no human could spot, let alone process in a lifetime. This power of AI lies in machine learning. By studying past events and understanding how specific factors influence the markets, AI can forecast certain trends. For example, it might identify that certain phrases in corporate news releases or shifts in trading volume have historically preceded declines. Armed with these patterns, AI can flag potential risks that would likely escape human notice. Let's take a real-life example. Some hedge funds are already using AI to monitor Twitter for sudden shifts in public sentiment. This data helps them adjust their positions faster than ever before. AI's speed and adaptability have allowed it to catch trends early, occasionally even getting a jump on the market. But here's where things get tricky. While AI can analyze more data at faster speeds than any human, it lacks something crucial: intuition. A sudden tweet from a CEO, a surprising policy change, or even global political tension. These factors can create market shocks that algorithms struggle to fully understand. Human emotions, irrational choices, and unforeseen external events all add layers of unpredictability to the markets. So, while AI may be exceptional at identifying patterns, can it handle the chaotic nature of stock market crashes? Or will it too be blindsided by the very human forces that shape these financial upheavals? Now, let's address the elephant in the room: the risks and ethical dilemmas that come with relying on AI to predict something as monumental as a market crash. If AI could one day predict such a crash, imagine the power it would wield. Those who control the AI, whether governments, financial giants, or tech companies, would hold influence over the global economy like never before. And that begs the question, would they act on those predictions? Or keep them to themselves? Consider the potential for manipulation. If an AI system predicts an upcoming crash, those in the know could sell off assets, sparking a sell-off frenzy and potentially accelerating the downturn itself. Or, worse yet, malicious actors could manipulate the data fed into AI systems to trigger false alarms or drive market prices in their favor. It's a classic case of power and responsibility, one that could shake the very foundations of economic fairness. Then there's the issue of trust. AI, at its core, is built on data, but that data can be flawed or biased. If the information feeding these algorithms is limited or skewed, the predictions might be unreliable. We've seen cases in other industries where AI systems have made biased or inaccurate predictions because of the data used to train them. Now, imagine the fallout if an AI miscalculated a market crash, inciting panic and leading investors to make fear-driven decisions. The ethical question is clear. Should we place this level of trust in AI when the stakes are so high? After all, these predictions impact real lives, real savings, and real livelihoods. But what's the alternative? A future without AI-driven insights, where we rely solely on traditional methods and intuition? As AI advances, society will have to decide just how much we're willing to let these algorithms dictate our financial reality. And this brings us to a final chilling question. Are we creating an AI that could one day save us, or a tool that could ultimately lead us into deeper financial instability? So, after all this, the burning question remains: can AI really predict a market crash? The answer is complicated. While AI has had notable successes in predicting trends in areas like consumer behavior and even certain short-term market patterns, the stock market crash remains an entirely different beast. Financial markets are influenced by countless variables, from global political events to unpredictable human emotions. Even the most advanced AI can't account for every potential trigger, no matter how much data it processes or how powerful its algorithms are. In fact, there have been instances where AI has flagged what it thought were high-risk situations, only for the markets to carry on as usual. And then there are times when AI has failed to predict sudden, massive shifts, proving that even machines with immense calculating power can miss the mark. However, the promise is undeniable. We're at a point where AI is more powerful than ever, with the ability to learn from past crashes and detect patterns that might indicate financial stress. But it's a double-edged sword. While AI might spot hints of an impending downturn, there's still a high likelihood it could raise false alarms or, conversely, overlook key signs. This unpredictability is part of what makes AI both fascinating and a little frightening in this context. While it has the potential to be a groundbreaking tool, its limitations remind us that we're not dealing with an infallible oracle. So, can AI help us predict a market crash? The technology is promising, but we're far from a future where it can accurately warn us of every financial storm. Ultimately, we're left with a question that may take years to answer. Will AI evolve enough to foresee the next big crash, or will it remain another tool in our ever-growing financial toolkit? Helpful, but not the crystal ball we're all hoping for. So, here we are at the end of our journey through the world of AI and its potential to predict the next big market crash. We've explored how AI can analyze vast amounts of data, recognize patterns, and even detect trends before they hit mainstream awareness. We've looked at the risks, the ethical concerns, and the challenges that come with trusting an algorithm to foresee financial catastrophe. And yet, one question still lingers. Can AI truly predict the next market crash? The answer isn't as clear-cut as we might like. While AI continues to make astonishing strides, its ability to navigate the unpredictability of human behavior and the chaotic forces of the market remains limited. Maybe one day, as technology advances, AI will become the crystal ball we're all searching for. Or maybe, despite all its power, it will always be a step behind the very forces it tries to understand. For now, we're left with a thrilling uncertainty. The tools are evolving, the data is growing, and every day AI inches closer to unlocking financial forecasting's deepest secrets. But until it reaches that point, we'll have to rely on a combination of traditional wisdom and a little bit of luck. Thanks for watching. If you enjoyed this deep dive into AI and finance, don't forget to subscribe for more content on technology's impact on our world. And if you have any thoughts on whether AI can predict the next crash, let's keep the conversation going in the comments below.